Africa Eats is a Pan-African holding company focused on food and ag in Africa. And it's made up of 27 graduates of Fledge. And we had finally got that off the ground. We've been working on that for a while. And we're out looking for a few $1 million of funding to make it big.
Very cool. Thank you, Lenny. How about we go to you next, Charlie? You're kind of next in my grid, at least, because you're working
the grid approach is great. Yeah, I'm really excited to be on this panel. I've obviously Impact Investment Group has a cordon of people that goes to SOCAP every year in particular. So yeah, it's really excited to be here on this panel with you all. So the Giant Leap Fund is an impact venture capital fund. So we are a $15 million fund that invests in early stage startups that fuse a for-profit model with an embedded environmental or social impact within that model. And the way that we define impact is across 3 key themes. So sustainable living, health and wellbeing, and empowering people. So it's a very broad scope of positive impacts within those 3 themes. The mission of the fund is to prove that it's possible to get market rate returns while also investing in businesses that can really scale their impact and create an outsized change in the world. So what else can I tell you about it? Yeah, I guess we've made 20 investments to date across those 3 key themes. And yeah, as an associate on the fund, I screen deals as they come in, so I can answer questions around kind of what impact investors look for at that early stage and kind of what the process looks like for seeking venture capital investment as well.
Sorry, muted. So easy to forget. I ordered a t-shirt yesterday that says "You are muted" on it, which I'm looking forward to wearing future events. I'll go through to you, Carrie, next to tell us a little bit more about your work. So CAP's been mentioned a couple of times now.
Sure, yes, I know. Well, and we are going virtual and we will miss having all of you in person, but look forward to more in-person events in the future. We are, we like to call ourselves a big tent. And so within that big tent, we are looking to bring together as many pieces of the impact ecosystem into the conversations. And so that includes entrepreneurs, investors, foundations, nonprofit leaders, government, municipalities, all of those coming together to represent the ecosystem. And then when you are in conversation within SOCAP, we are really talking about the intersection of money and meaning. And with that, part of what we are really wanting to look at is accelerating how are we moving impact and then putting that in connection with markets and the capital markets and really finding market-based solutions. And part of what we've been doing for the last 13 years is, yes, having this, this flagship conference that typically takes place in San Francisco. However, with the last few years, 2 to 3 years in particular, we have been pivoting to be a year-round content provider model. And so with that, we have a podcast, we have blogs, we are now with COVID putting up tons of other virtual events and really trying to provide resources and connections for that entire ecosystem. And so I'm looking forward to the rest of our conversation.
Oh, me also, and that at least last but not least, as they say, you, Paul.
Kia ora, tēnā koutou, tēnā koutou, tēnā koutou. Greetings to you all from Nelson in New Zealand, Aotearoa. It's a real privilege to be involved in the panel today. I'm here in my capacity as one of the co-founders of Red Hat Impact. At Red Hat Impact, our mission is effectively to grow impact by growing impact enterprises, particularly SME impact enterprises that are finding their way forward. We use, as Tom alluded to, we use impact debt investment, and we do that in an innovative way. We basically run what's effectively a syndicated commercial lending system, or crowd lending. As recently as last week, we've been able to mobilize $1.2 million worth of capital to go to mostly SMEs, across an impact investor network of about 35 investors, supporting about 12 or 13 enterprises. And so we're very much hands-on. We provide that capital support. We also provide consulting and business support services to the enterprises that we work with. And we also work really strongly around connections across the ecosystem between different players, and we try and leverage the power of those relationships to bring impact together. Looking forward to the chat today.
Thank you, Paul. Thank you all for being here. Well, let's kind of kick it off in a fairly broad way. You know, a big part of what to achieve over the next hour is to kind of just demystify a little bit of what's happening out there. What are the options? My expectation is that the majority of the people listening are more on the other side of the fence, people who are themselves working on impact initiatives or contemplating an impact initiative or wanting to grow, or may either in the very soon or a little bit later be looking to access impact investment. So why don't we start just by saying, you're all very active in space. What do you think? I'd love to hear from each of you. What are some key, misunderstandings that people have about what we mean by impact investment, or what the opportunity for impact investment is and who it's appropriate for? Who would like to kick off on that? Thank you, Lenny.
All right. Misunderstandings. I'd say there is a continuum of what it means to be an impact investor it's actually a continuum between philanthropist and Wall Street investor, and impact investing is everything in between. And because of that, it tends to fall into the two corners of that spectrum. There are many impact investors who say it's immoral to make money on poor people, and therefore market rate returns are immoral. And then there are plenty of impact investors out there that say, no, impact is inherent in what we do. Everything should be impactful, and therefore you shouldn't have to give up any return for doing the impact. In fact, you should make more. But the reality is that it's a continuum, and there are investors that fall everywhere in that spectrum.
So the misunderstanding that perhaps that people have, and I agree with this, is that it's a single thing, perhaps, whereas it's that spectrum of,
what makes it really confusing is it's everything but philanthropy and Wall Street investing. And that leaves a giant space in between.
It's interesting. Does anyone disagree with that definition, that everything but, that it fills that full spectrum?
So I don't disagree, but I'll just add to that there is certainly, from what I've seen, different problems require different types of capital. So along the impact continuum, the spectrum, if you will, capital plays different roles along that, I feel, and for me, it's very problem led. So there's certainly some problems that will never have a for-profit solution. One that comes to mind is homelessness or extreme poverty doesn't have a for-profit solution that can inherently make sense for that particular problem. And that's where you'll see the types of capital that suit that shift more towards the philanthropy side of things. And then as you go more to the for-profit end of the spectrum, things where, somewhere where a problem where profit and impact is very much aligned are problems around sustainability. Because if you're reducing wastage in a supply chain, or you're reducing electricity consumption, you're creating cost savings, which is your profit increase, but you're creating impact very cleanly in alignment with those two things. So it's definitely different types of problems will manifest different types of capital along that spectrum.
And maybe I would just jump in and to piggyback on top of what Charlie was saying, that there's also specific types of capital that are really meant for specific solutions, and that you can move through different types of capital as your enterprise grows. And so you can start off with either, just a grant and then you get to move into other forms of impact capital as you and your company, or you and your venture and your solution also progress. And so that that can also really help you determine where you start to enter into the impact space as well.
Mm.
And the only thing that I reckon I'd add, I agree with everything that's been said, and the only thing that I add is that it's a fairly dynamic space that we're in. So, you know, like I think particularly for problem-led and innovative thinking around how finance and capital can be used, you know, I guess the ways in which we can think about impact investment are kind of expanding from a narrow understanding to a broader sense of what's possible when we think about finance differently.
That's obviously changed a lot since, I mean, I don't know exactly when the phrase was even coined, impact investment, but obviously, I mean, certainly since, when was SOCAP founded, Carrie? I feel like I went to my first SOCAP in maybe 2010.
I was going to say 13 years ago. So we like to say, and there's a lot of debate here too, but in 2008 was when impact investing and the conference really started. But there are a lot of folks who can take that, you know, all the way back to St. Francis of Assisi and just really, so there's a broad range there. So that could be one of the points that we could have a discussion about.
Yeah. I love pointing out that, you know, crowdfunding's, you know, only about, you know, the phrase is 13 years old or something, but public subscription was a thing that people have been doing for centuries to fund, and that's just a new phrase. So often the case, I think that, you know, I think particularly in the social sector, what we discover is it's actually kind of old practices made more official and brought to scale that proved to be most of it. It's not that we're inventing new human practices. You know, people have always been philanthropic. People have always wanted to support positive impacts. It's, I think, a lot about building the infrastructure and the culture around that. So what have you seen change? I mean, I know you weren't right there 13 years ago, but kind of organizationally and just your own, you know, career in the space, what do you think are some of the key things that have shifted over the last 13 years, even in this conversation?
And is that to me, or is
sorry, Carrie, that was to you,
okay.
and then to whoever else wants to riff off that. Very interested in your take, Looney.
Sure.
I know you've been at this a long time.
Yeah, I would. So from SOCAP's inception, part of our role was to really bring about a larger conversation and to really help capital markets, but financial markets also shift into thinking about impact and really working and moving with purpose. I would say delightfully what we've been able to see over the last, you know, this will be our 13th year, is a real acceleration toward mainstream and really bringing in not just mainstream forms of capital, such as banks and intermediaries and wealth managers, but also pension funds. And then further, really starting to look at how are corporations really beginning to look at impact in a profound way, and then individuals. And so that each one of us really have a place in an important role to play in this entire, you know, full capital markets. And it's been the acceleration of that I think is really exciting over the last span of years. I think with that then also comes a couple of, you know, pain points or tensions. And I think specifically to this group, one of the pain points that I've noticed over the last couple of years in particular is a real tension around investors and entrepreneurs being able to find each other in a way that is not only authentic, but easier for both sides, for an investor and for the potential investee. And then also for the impact space and impact investors, but just any investor, to be able to be really clear about what they are funding and how they are funding. And then being able to have entrepreneurs say the same thing, like, this is really the type of capital that I need and want. And these are the other resources that I need that are not just capital. And so that we're really also starting to look at the full needs of an enterprise as a part of this investment continuum. So I would say those are just kind of like, we started, and then we're really starting to, as we gain momentum, start to look at the multifaceted layers and needs of the entire system. And that the last thing I would say is, and I'm sure someone is going to hop on here, is impact measurement, and really trying to say, like, how do we measure impact, and what does it mean to not only measure at scale, but to measure impact for the end users and for the communities that are being impacted with the solutions.
Joe, you called me out for being in this space a long time. 8.5 years. I've only been doing it for 8.5 years, and I still feel like I'm new to this space. More often than not.
I feel like I must have met you about 8.5 years ago, and I thought you were.
Yeah, when the
I grew already, Looney. You obviously impressed me at the time. I thought you'd been at it forever. Right.
I know about. Yeah, I've been doing startups for 28 years.
Yeah.
So when it comes to like entrepreneurship and whatnot, that I've been doing for my whole career. But in terms of like applying that to the world of impact, to me it was 2012. Yeah. I've been going to SoCap every year since 2012. I've spoken at a lot of them. Awesome event. Brought it to Seattle, in fact. What's changed, what I've seen significantly changed with no hard numbers attached to it, is more and more institutions doing impact investing. So clearly more individuals, but that's impossible to count. I would hope by now that there would be organizations measuring the industry, but all we really have is a GIN survey once a year or twice a year. And it's only surveying about 200 organizations, if that. And so we just don't know. We don't know how much bigger it's growing. We should all by now understand exponential curves. Maybe not the New Zealander here, Paul, but the rest of us should understand exponential curves. And we're in an exponential curve of impact, but I don't know if we're the equivalent of February or May or in a lull this year. We just don't have any measurements for it.
Charlie and Paul, is there anything you want to add to that?
One thing I'd say. Sorry, you go, Charlie.
Go, Paul.
Okay.
No.
One of the things that Red Hat Impact, why we came about, is that we work in what we call the missing middle. So one thing that we noticed when we were all working in and around supporting smaller and medium-sized businesses that were trying to do impact, is that they were finding it very hard to get any attention from the big end of town in the impact world. Venture capitalists, institutional investors, equity investors, etc. wait until businesses are a certain size and a certain track record before they might come to the table. So for us, one of the things that we've been really passionate about is thinking about how can we meet the business where the business is at. And if we've got a business that's a startup, and it's looking for its first small lump of capital to keep proving out its business model, keep proving out its impact theory of change. Let's try and meet that business where it's at and think about how we might be able to assemble a safe amount of money and put some supports around that money so that we can actually get them moving forward. So one thing that I think is I guess changing in our world is that we're seeing that this way of doing things is becoming proven, and as people have participated with us in the model, our impact investment network grows, and it's growing quite quickly now, as people see that this is a way, particularly what we call individual retail investors can see that this is a way they can also step forward into this space without needing to get into the complexity of a really large investment around equity or some other kind of larger instrument.
That's great. Well, that definitely, I think, brings up a key question that I wanted to touch on, which is what are the gaps that still exist? People ask me this all the time, and I always say there's not, there are gaps, but that's not there's not enough of anything, to be honest. I think like the whole ecosystem needs kind of more at every stage, and I think we're kind of there yet. But certainly it feels like we're kind of making more progress in, if you think about kind of what you guys are describing, which is kind of a complicated ecosystem where there's obviously ventures at different scale or at different stages. There's different types of issues, some of which are better suited towards different types of capital. And of course, there's a variety of different kind of potential investors out there who want different things, from Wall Street types who want exactly what they've always, what they're used to, through to philanthropists who want maybe more measurable and specific impact. Looking at that whole ecosystem, I'm interested in where you each think some of the key places where we need to put more effort in. What are some of the gaps? Paul's spoken about how Red Hat you know, they exist because they saw that there was a really key gap kind of around that post-launch but pre-investability at scale stage. I'm interested in what the rest of you think is where some work is most needed. Who wants to go? Who wants to jump in? Open invite.
Yeah, I'm happy to jump in first. Yeah,
thanks,
I think that gap it exists in early stage companies, no matter what your growth potential is. For companies that plan on being, you know, if it's a $10 million opportunity or, you know, $1 billion opportunity, it doesn't discriminate at that early stage. There is a gap that needs to be filled there. We see and we've got a very myopic view of the impact space, because we do look at for-profit ventures, and the real gap in this space is funding at that early stage for really high risk, but you know, the innovations that are really breakthrough companies find it really hard to find that funding at that early stage. And where the venture capital model in general, I think, fails is it doesn't allow, or it doesn't account for breakthrough innovations that are high risk. It is leaning more towards kind of optimizing solutions, optimizing style businesses, because it can kind of be, you know, it can be imagined, it can be seen, and so there's a lower risk for investors to jump on board for venture style investments. So I think there is a real gap at that early stage that requires, I think, you know, Launch Vic's opinion in Melbourne is that the gap can be filled by angel investors that have a higher risk appetite for that really early stage. And I think they've done some great work in building angel networks to try and fill that gap. We've launched an impact angel network for this space to bring together impact angel investors for businesses that are pre-revenue but have a really strong impact mission and impact intent behind it. But I really think that there is a gap here that perhaps needs more support from government sources or other sources to fund those higher risk but potentially higher impact breakthrough kind of innovations.
Yeah, definitely think so. Heard from the two folks on this side of the Pacific around some of the gaps. Are those the same gaps you guys see in North America, or are there slightly different kind of gaps or challenges there?
I'm going to sum it up to say I do my work all around the world. It's the same all around the world. It's simply the fact that this industry lacks capital. There are way more ideas than there is capital. And because of that, the capital gets concentrated in little pools, and there's gaps between the pools. As we add more capital, that capital will try and differentiate itself, and we'll fill in these holes. And these holes are everywhere, absolutely everywhere. The one that I helped fill up slightly last year was invoice financing. We had this flurry of companies that came through the accelerator, and they had orders, but they didn't have the money to actually go get the products put together to go fulfill the orders. And we couldn't find an invoice financier we found two in Africa, both said no, like wrong country, wrong stage of company, wrong whatever. But we found two in the whole continent of Africa, right? Two serving 1 billion people. And so we've just raised a fund to go fill it ourselves. And everywhere you look in terms of, if you came to the States and you had a traditional company, and let's just say venture scale, because then it's even easier, and you come across a moment in time when you need an equipment loan, well, there's 100 companies that do equipment loans. And if you need invoice financing, there's 100 different companies that do invoice financing. And if you just need a credit card processor, there's 100 of those. And if you need a loan from your credit card processor, there's dozens that do that. And it just falls down to the fact that there's plenty of money for a traditional asset-backed company. And there has been for 100 years. And all those gaps got filled in with capital.
I would agree. And I would also just underscore the early stage and the risk capital, along with and again, if we kind of pop ourselves up as the top of the funnel view of all of the ecosystem. I would also say we're missing there are some gaps also around education. And so helping entrepreneurs or ventures understand the impact portion much earlier in their business and their creation cycle. And that by doing that, they're also starting to identify different pieces of not only capital, but how to perhaps mitigate some of the risks that are showing up for investors as they move along and through the cycle. And then, of course, for us here in the States, we have to and must move more capital to founders of color. We have just abysmally low amounts of capital that are moving to founders and women, and we just must move more capital. It is not a pipeline problem. This is truly, there are amazing ventures out there, and this is truly about moving more capital and moving it faster.
So can we just hone in on that for a moment? I think that's a really interesting specific challenge where, as you say, it's not a pipeline challenge. The opportunities exist. You know, there are. If you go looking, I know this is true too, because we do a lot of work, but you know, like looking under the hood and going, who in this community has a great idea? And every community is filled with people with wonderful ideas, many of whom haven't received the support, or there isn't the infrastructure, or there isn't the opportunity for them to progress that idea in the way they'd like. So I 100% agree with that. What then can we do to fill that gap? What's the, you know, how do we convince people to invest in something they're not currently investing in for whatever reason?
Yeah, we need, what's missing, I believe, in that area, and I've been only researching that for months, not years, is the right investment structure. So what we see here in the States is that the organizations that do lend in those communities are what we call CDFIs, Community Development Finance Institutions, a structure created by the federal government 50-ish years ago. And they're supposed to invest in areas that banks won't invest in. And why won't banks invest in those areas? Because there's a history of what we call redlining, of specifically not investing in those neighborhoods because of the demographic of people that live there. So just straight up racial issues. And these CDFIs, to go back to the lenders that are doing it, they're nonprofits that typically lose money every year doing what they do. So the loans are too small. The cost of creating and servicing the loans are too small. The people they're lending to are not in the credit system, so they're much harder to figure out whether to lend to, and they're only doing loans. And so they're losing out on this other whole portion of investing that we have for companies, which is equity, which is usually the wrong answer also. And what's needed is something else. And there are a few ideas out there. I do use one myself at Fledge. There are a couple ideas out there, but none of them are at scale, and none of them are in those communities. So I think what we need to do is bring to the market something that that every retail investor could say yes to, that produces a reasonable return for the investors, produces capital at a reasonable cost to the entrepreneurs, and we don't have that.
If I could just do a quick shout out, there's been some great questions in the chat. I'm trying, Looney's doing an amazing job, but I don't even know how he's responding to so many people in the chat while also seeming to be up to date with our conversation here. I'm struggling to go back and forth. What I was going to ask is, if anyone does have a question, I'd love to pull in some of the great questions that I know you all have. Could you please use the Q&A function, just so we can separate out some of those key questions from the rest of the chat, and I'll definitely pull in a couple of those in the next, you know, before the end of the hour. So I think, Looney, you're bringing up a really key issue that I wanted to spend a little bit of time on today, which is the different styles of impact investment, or the different types of capital, different approaches, so that people can think a little bit about what potentially is the right for them. And I guess connected to that, when should you even be looking at impact investment at all? So as someone who works a lot with, I guess, both cultivating the investment side, but also the enterprise side, when do you think people should be starting to look for impact investment? And could you kind of just flesh out a little bit more what you were saying about the different types of options that exist or need to exist to create more options? And then I'd love
Sure.
to get the rest of you to respond to that as well, as you wish.
So the advice I give to all the entrepreneurs I meet is don't bother looking for investors until you have a product in the market and some customers. And that's a novelty that, you know, again, I've been an entrepreneur since 1992. That was not true back then. You could go find angel investors you couldn't do PowerPoint because it wasn't around yet. But yeah, my first company's business plan was written on a piece of paper, like handwritten on a piece of paper. And my fourth company was a PowerPoint and got funded by venture capitalists and no customers yet. That's all gone. There are patrons out there, there are grants, and there are crazy investors that will write you a check who are really not expecting their money back. But these days, usually you have to have traction. You have to have something that's proving what you brought to market is wanted by customers. And so that's where it starts. And not a minute before. And then usually it starts with your local angels.
So meet people in your local ecosystem and start developing those relationships.
It's not true that one of the big differences between impact investing and traditional startup investing, traditional investing is still 70-80% local. That if you're doing a company here in Seattle and it's not impactful and you're out looking for venture like angels, you're going to get funded in Seattle. You may get funded in California. You're not going to get funded in New York, and you're certainly not going to get funded from Sydney. Maybe online, right? But first investors are probably going to be from Seattle. That's not quite true in impact. There are plenty of investors in Seattle who are individual impact investors or family impact investors that don't invest in Seattle. They only invest in Latin America or India or Southeast Asia or Africa or somewhere else that's not here. And so if you're over there, if you're outside the developed world, then your investor's probably not local. And then how do you find them? That's a crazy story.
Yeah. Paul, I'd love to bring you in to get your thoughts on those different genres of, or kind of when should someone start thinking about or focusing on impact investment? I know you do a lot of advisory with companies looking to grow as well, who I know are grappling with this question, and so interested in your thoughts.
Yeah, well, so one of the key things to remember here is that we're talking about businesses, right? We're talking about businesses that are either for profit or they might be not for profit, but they've set up business models and they're trying to operate in a way that brings revenue in the door, meets their costs, and delivers benefit. So like one thing that we're really strong on is to not think about impact enterprises and not encourage impact enterprises to think about themselves in any different way to a mainstream enterprise. I think that's a really important thing to think about, because I think there is a kind of a natural curve of capital types that mainstream businesses will take on as they start up, stabilize, grow, and potentially exit themselves as well. So, and I think sometimes, that sounds really simple, but when you're right in the middle of setting up something, it's easy to, and particularly if you're driven by passion, you're thinking about impact and the problems that you're working on, it can be easy to forget that, you are still organically growing or trying to grow like any other business might. So the starting point is to really sort of appraise a business, appraise your business against that curve, and work out where you are in relationship to it. And I certainly agree with what Looney said. I mean, most of us start something through our own money or through money off people that are close to us, and they know us and they get us and they trust us. I mean, once you're through that phase, though, you need to be starting to think about, well, have I got a product? Have I got a market? It is out there in the world. Do I need money to grow my sales? Do I need money? Do I need more stock? And how do I get money for a small amount of stock that doesn't put me at a great risk? And so it's the same sort of questioning process that you would go through as an impact enterprise. And I think that's a really important principle to hang on to. Then though, of course, the beauty about being in the impact investment world is that you have got people that I think, particularly if they also share a passion or an interest with you in the kind of impact that you're trying to deliver, you've got people who will come and look at the impact side of your story and be motivated by that as well. At Red Hat Impact, when we're thinking about taking deals to our investors, we basically look at the impact model and the business model together. We satisfy ourselves that both of those things can work or are working, and then we take those deals forward.
Charlie, were you about to say something?
No, I was just going to say just
Kate.
just right on top of that, really thinking about how your impact is growing in a different way than the business as well. So your business is, of course, going to move along, but how is your impact growing differently or within the same level of your business? And I think it's that impact story that if you are going after capital that is specific to impact, you can hone in on that, but it has to be fully aligned as you go.
Charlie, did you want to add anything to this topic? When do you advise? I mean, people must approach you at all sorts of, I'm really interested in actually your take on this because you are the kind of front of house for impact investment firm, so to speak. People are approaching you, and I imagine many of them approach you at not the right moment for you. So when is, when someone approach, what is the perfect moment for someone to approach you and you're like, I'm so glad you got in touch now, let's talk?
Yeah. So I think the unsatisfying answer is just as a general statement. The unsatisfying answer is it depends on the investor, and so you need to. I think the piece of advice is you need to understand when you're having these conversations and you've decided that you do need to seek capital. Having those conversations and doing the research on investors and what kind of stage they will be looking at, because every single investor has a set of kind of like rules of thumb or a mandate or criteria around this is where they like to invest. Every single investor has a sweet spot. So you can ask that question. Investors are happy for you to ask, what is your sweet spot? At what point do I need to be at a business for you to be interested in making an investment? If I'm not ready now, when will I be ready to meet your mandate? What kind of things would you be looking for in my business? So it's definitely for us, for example, we invest in seed stage businesses and Series A stage businesses, and we have a hurdle requirement that businesses need to be generating revenue. And for a Series A stage of investment, the hurdle there is $1 million in annualized revenue. So there is different gates that we use to help us understand kind of where the business is at and in what bucket they fit in terms of where we like to invest. And so when founders ask us that question, we're very, very happy to kind of answer that. The other thing I will mention is the question of when is the right time for investment is for me also a question of, do you need outside investment? And this might come as strange coming from somebody working in the business of investing in startups, but we always ask founders, what is the reason that you need venture capital investment? Because it is a big commitment, and you are selling a part of your business. You're entering into a long-term relationship that'll be 10 years with an investor whose their goal is to make a return, and that's a combination of impact and financial. So you begin to bring in other parties' motives into your decision making. So that's one thing you need to consider. And then the other piece is if you can fund your business through the revenue that you're generating and reinvest that revenue into your growth, and you end up growing the business successfully by that method, you'll own the business at the end. And we've heard or seen many founder stories where they've been successful in doing this and thankful kind of at that end result when they've been able to capture more of the value of their business. So venture capital, I think, just to summarize when it's good to use, it's really good to use when you have a big market opportunity that's going to take negative cash flow for a while in order to achieve the growth to capture it. So yeah, just thinking about that negative cash flow could be in product development or marketing to get ahead of your competitors. But when you need to fund kind of that negative cash flow, venture capital and equity is a worthwhile investment vehicle to pursue for your business.
Yeah, definitely. And so that's a good definition, actually. That's quite a tight definition of like, when does equity investment make sense? You know, when you need to spend more than you're making for a period of time, you know, someone's got to fill the gap, and that's the job of investors, provided that they believe that, you know, the long-term result of that will be capturing more market share, or, you know, then generating more profits later on. What then, Paul, at WR, do you have a similar sort of snapshot on you should raise, and Looney, interested in your take on this, because I know you play with some really blended mechanisms and different mechanisms, but if that's the you should raise equity if, what's the you should raise debt if equivalent of that for you?
So, yeah, okay. So, like, obviously, the first thing is that debt is a little bit riskier, right? So, you know, you're signing up to an obligation to pay someone back, and though at Red Hat Impact we try and keep our debt contracts really straightforward and simple, I think the first question that you really need to ask yourself is: have you established within the business that you're running, have you established a revenue stream that's reliable enough for you to be able to meet an obligation to pay back down the track? I mean, that's the fundamental first question. What we do a lot of at Red Hat Impact, though, is we can structure our debt arrangements in ways that enable businesses to take on some money and then give them time to find their feet around the use of that money. So often we will build in a repayment holiday, for example, to enable somebody to get some money in, to maybe get some stock in, and then maybe make some sales, and then start generating some further cash, maybe growing their cash revenues, and then start paying out from that point of view. I think where the question for debt is really important is that you can no longer survive on you know, family, friends, and fools. You've maxed out that bucket, and you need working capital. You need working capital, but you don't want to. You're not in a position to. You're not ready to. You're not mature enough to be starting to think about selling parts of your business, and this is another really important principle as well. You know, sometimes I think what happens in this space a little bit is that businesses represent themselves or redesign themselves to try and fit the funding opportunity, and we would say that's not the right way to go. What you need to be doing is you need to be thinking about the right funding opportunity for the stage of business that you're at. So for us, it's usually when people come to us, when businesses come to us, they're usually sort of saying, we've got a really good opportunity for growth here. We need some working capital to do this. We've got a product, we've got a market, we've got a revenue, but we don't want to sell a business. We don't want to sell a part of the business. We don't want to give up. We don't want to give up our opportunity. You know, how much can we safely take on? And it's from that point of view then that we pick up with that, and we think about how we can structure that so that it's supportive.
So maybe not quite as pithy as if you're planning to run deficits, raise equity, but I think that gave a good flavour for some of
I think we got our first controversy here, because I'm going to jump in and say, no, Paul started by saying debt is more risky than equity. No way, equity is way more risky than debt, because step back 8 steps, and the equity investment is crazy, right? So I give money, and I do this. I give money to a company, and they promise not to pay me at all. They promise that they won't pay me a dime ever, and that I'm owning a percentage of their company, and we all have a hope that someday somebody buys this company, and that percentage turns into more value than I gave them. So that's a very high risk investment. Now, my organization doesn't die if that doesn't happen, which is the difference between a venture capital fund and a debt fund. Yeah. A debt fund, if they don't get paid, they have trouble, right? They don't get paid.
It's a point. It's a point well made. It was a point well made. I think the point that I was really sort of pointing to there is the perception of risk for the entrepreneur is that, you know, that sometimes the idea of taking on your first debt obligation as a business is a scary, risky proposition from that perspective.
True. And as an equity investor, we have no recourse, really. Yeah. If the company does poorly, we write it down. We can't take over that company. We can't force them into bankruptcy. So debt investors have a little bit more control. But my primary instrument at Fledge is actually something in between. So the way we invest in Fledge is neither debt nor equity in the traditional manner. It is something literal that is right in between. We use an equity form, but it's really a rev share. So we're providing money to a company, and they are obliged then to share back a percentage of revenue. And we do it in an equity form. We buy some shares, they buy them back. The prices are all set ahead of time. And that's working really well. And I think something in there is the answer for 99.9% of the companies that aren't venture scale. Maybe not exactly the way we do it. Maybe not exactly the way others do it, but the answer's in there somewhere in that space.
And then does the company get to decide if they want to buy back that equity or leave you as an equity holder? Like, does it give them that flexibility?
I've seen those. I've seen structures where the company can choose. I've seen structures where the investors choose whether they get redeemed in any given year. The structures that are working best are the ones where it's just obliged. They are legally obliged to buy back the shares. And then in reality, what happens is that when that obligation comes around, we, the investors, say, you know what, you need the money right now because things happened. Keep it, pay us next quarter. And sometimes we'll do that for a year. And so in reality, we have the option of whether to get redeemed or not. And then
but it's only triggered when they're at a certain revenue or profitability rate, right? Is that right? If they're kind of not making money yet, it doesn't come due? No?
I don't like, I've seen that as well. I don't like that. It doesn't, it gets the investee in the habit of not paying. So I personally don't like honeymoons because it gets the borrower, whatever the person taking the capital, in the habit of not paying anything and not paying attention to that. And then when that honeymoon is over, however you set that, all of a sudden that feels onerous to them. I prefer the version where they're obliged from day one to pay upon the next quarter, month, whatever. And when that time comes, I, the investor, say, yeah, not right now. And now they feel better about the investors. They're in the habit of talking on that cadence. And I get one extra bonus point of being a nice guy by saying, don't pay me.
Yeah.
And then everybody comes out happier. So sometimes like the little tiny bits of structure that aren't actually in the paperwork. This is not in my paperwork. My paperwork says you are obliged to pay every quarter. But it turns out to be a much better relationship when we just ignore that.
I like that. Okay, guys, there's a bunch of questions that we're not going to get to all of them, I'm afraid. And I should have switched over earlier. Thank you, everyone who submitted questions. I want to do kind of a rapid fire session. I'm going to just try and pick a person for each of these, and I'll pick four quick questions, and ask each of you a different one, and so we can get through a few rapidly. If you have something that you urgently want to add to someone else's question, if you think I've picked the wrong person for the wrong question, you're very welcome to jump in. But let's see if we can get through a few this way. There's a question from Caroline about how to get philanthropists and foundations more involved. That, seeing as they're already writing checks that they won't get back anyway, can we get them more involved in, I guess, riskier investments? I thought maybe, Kari, the work of SOCAP being kind of at the kind of intersection point of so many different parts of the ecosystem, philanthropy and investments, or you might have a take on that?
Sure. Well, I mean, every philanthropic entity is different. So that's also part of the equation, and how they're approaching their investments, particularly if they're doing program-related investments or mission-related investments. It's different, coupled with grants. So some foundations have all of those working together. So both sides of the house working together, the grants and then the investment side, and then others do not. And so I think one of the places that I'm really excited and we are watching more of and helping to put more of this out there is Catalytic Capital. And I know, again, that's not for everyone, but it's this idea of really starting with capital that can help get into and seed some of these ventures and ideas that are not getting access to capital. But then also having philanthropic entities look at the blended finance and where in the capital stack they can play differently. And I think that's where we all can probably help to push a little bit more with the foundations and in other philanthropic sources. And we're seeing a lot of that and a lot of interest in being able to work differently and work within those capital stacks, which I think is a pretty important next step if we're going to grow the field.
Great, thank you so much. Another question I want to pull out from Sunny is about how investors think about risk in an emerging market context versus an established market. You touched on that already, Ludi, so I just want to invite you to address that a bit more. Do investors think differently about the kind of risk reward profiles in these different types of markets?
They certainly worry about the risk, yes.
So they worry more about risk in a
Oh
emerging
yeah,
market?
far more about risk. Yeah, political risk, just unknowns. And then on reward, it actually flips the other way. Usually, at least the crowd I'm hanging out with, which is the impact investors into the emerging markets, not the tech investors, they're saying, well, since we're having a better impact, every dollar we're putting in has a better impact or bigger impact than it would if it were in the States or in Europe. Therefore, we don't care if the reward's any bigger. So we break that traditional risk reward curve by
Right,
going.
so they're more aware of risk, but they don't require as big a potential return to counterbalance that.
On the landscape, it seems to be that the investors that invest over into the emerging markets are closer to the philanthropy side than the Wall Street side.
Right, even while pursuing investment mechanisms, that's more the thinking.
Yes.
Yeah.
And I'm sure there are some over on the Wall Street, and I'm just not finding them.
Yeah. Well, maybe to build on that and to bring you, Paul, Red Hat Impact has been doing work in the Pacific as well, I know, and elsewhere, and obviously kind of looks across, maybe not globally, but the Asia Pacific and Australia and New Zealand and so on. There's a question on the role the SDGs are playing. This is someone pointed out the Sustainable Development Goals on the wall behind me.
Yeah.
Ludi, you mentioned them in a comment earlier, and just what's the impact they're creating, I guess, in the impact investment world? Are they creating a lens? Are people pursuing? Are people using that as a way of assessing impact and selecting investments as a result?
Yeah, look, definitely. Certainly, obviously, the work that we're doing in the Pacific at the moment, it's one of the lenses through which the group of investors that are working with us on that project are looking at this through, as well as a gender lens. The gender lens perspective is very strong for the Pacific as well. I would say that the SDGs are gaining currency in the impact investing world. There was a impact investing summit at the Impact Investment Summit last year in Sydney. I started to kind of notice that there was a lot more visibility around the SDGs and a lot more conversation around the SDGs as being part of the way in which we need to think about and look at delivery of impact. There were a lot more questions about the SDGs and how they can be brought into play in impact investment. And that was different compared to the first handful of, I think I've been to 3 summits, the first 2 summits. There wasn't so much visibility around the SDGs. So I'd say that they continue to rise as an area of interest for investors. And it's one of the lenses that they'll bring to their decision making about, particularly in emerging markets, about how they play a role. They can play a role everywhere, of course, but emerging markets seems to be where we're paying attention at the moment.
Yeah, cool. And final question, and then I'll give you all the chance to share any final thoughts or links or anything you want to shout out. But we're basically out of time, and I want to respect that in Sydney, in East Coast Australia, this is a lunch and learn session, so people have their work day to get back to, and we've all watched the sun disappear behind you, Carrie. So I know it's dinner time for those of you on the Pacific, the other side of the Pacific. So Charlie, there's a great question here just about. So I'll just read it actually from Laurel. Assuming the financials are clear, do the direct and indirect impacts of the business need to be measurable to attract impact investors? I'm thinking about the difficulty of quantifying externalities, for instance, in the environmental industry, and how they chase their tails with carbon emissions, mitigations, offsets, etc., etc. In many cases, the long-term benefits aren't quantifiable. So I guess, if I could summarize, if the kind of, I guess, business model is very clear and compelling, but the impact model is, I guess, understandable but unquantifiable, is that something or as yet unmeasured, is that something that's likely to attract the interest of an impact investor, in your experience?
So for us, the way that we think about it is, we appreciate that there's externalities that are going to be hard to quantify in so many cases. For our, we kind of have the 2 questions that we ask to make an investment are: is there a commercial potential here? Is this going to be does this have the potential to be a 10x return business or an incredibly high growth business? And on the impact side, we have a different set of questions we ask. We ask 3 key questions. The first one is the impact embedded into the business model, which means, is there some positive social or environmental impact that with every single dollar of revenue generated, you get that incremental positive impact for every single dollar. So really baked into the business model. And then the second question we asked, which is relevant to what your more relevant to your question, is can the impact be measured? And so we really do need to be able to see to some level what is the impact that is embedded into the business model that can be measured, and that really does need to be a number that we can measure, and that's in order to hold ourselves accountable. That's in order to hold the founder accountable, and in order to show that impact actually scales as the business grows. So that is a threshold for us to receive investment, and then we work with founders to try and capture some of those externalities and boil them down to the metrics that really tell their impact story, but also quantify some of that impact that's being had. But it's an incredibly difficult question. It's why impact measurement constantly comes up as in kind of the gaps to solve in this market, and there's so much kind of discourse about it. But for us, our methodology is that we do need to see something that is quantifiable.
Yeah. Great. Well, thank you all so much for your time and participation today. This has been so rich. I feel like we could talk for a lot longer. There's many more questions that sadly we won't get to. But thank you everyone who has turned up and paid attention. I just want to acknowledge before everyone jumps off that this event was free for Think Act Change members, thanks to the support of the Darling Square Community Bank, who are our partners in relaunching that event program. So we really thank them for their support and for all the Think Act Change members who turned up. If you're not a Think Act Change member, and particularly if you're based in Sydney, search Think Act Change on Meetup and become a part of the group, and you get invited to future events like this. And obviously check out all the Start Some Good ecosystem. If you're looking to launch a project and want to raise money from the crowd rather than from traditional investors, you should check out startsomegood.com. And if you have an idea for a social enterprise that you want to design so that it's launch or growth ready or investable, I definitely recommend you check out our social enterprise design program, Good Hustle, at goodhustle.online. Finally, I'd love to give all of you a chance just to share some final takeaways or some links, or how people can kind of follow you and your work in the sector. Let's go Charlie, Paul, Kari, and Looney.
Sorry, can you just repeat the two things?
Yeah, just any takeaways you want to share with people, and particularly if there's any links, like how people should keep up with the Giant Leap Fund, Impact Investment Group, and the work you guys are doing. Kind of similar. I modeled what I was talking about.
So follow me on LinkedIn. I've just put my LinkedIn in the chat. We also run a newsletter called Small Steps, which is a combination of what Giant Leap's doing, so it's keeping up to date with kind of the events we're going to and portfolio updates. But it also has it's a bit of a passion project for us, where we follow the trends of impact founders and impact stories in Australia, because we're really interested to see this ecosystem growing and kind of tell the stories of its growth along the way.
That's great. Highly recommended that newsletter and their podcast, and just all that. You guys are making more and more content, Charlie. I've really noticed that. It's very cool. Over to you, Paul.
Yeah, so best place to follow Red Hat Impact is to pop along to our website. We're going through a bit of a refresh at the moment on our website, so we're uploading new information all the time. We've got a bit of a video there, which is about our first 4 years and where we're thinking about going next. So there's some really interesting thoughts to share with everybody there. And look, the final thing that I'd love to say to this group is, I think that it's upon us all to keep thinking about how we put finance at the service of problems. I mean, I think we kind of all get that impact investments are different to mainstream finance, and I think it's constantly something that we challenge ourselves with at Red Hat Impact, is how do we think about putting finance at the service of problems and not problems at the service of finance.
Fantastic, thank you. Kari.
Well, of course, I also popped in my LinkedIn. Feel free to reach out, and I look forward to connecting. SOCAP, we have lots of articles, lots of content. Of course, we are doing regular webinars that are free. And then we have our large virtual event happening in October, and would love to have you participating as a part of that.
Right. I put a whole bunch of links in the chat window. I'm at fledge.co, realizeimpact.org, africaeats.com. I did forget my personal blog is lunarmobiscuit.com. That's what Looney stands for. And for all of you impact investors out there who are looking for deal flow or want to share deal flow, get things funded, that's investorflow.org.
Brilliant. Thank you all so much. Thank you to everyone who attended, and thank you for the work you're doing to build a better future and support the growth of this important ecosystem and sector. Wonderful to chat with you all. It's been a real pleasure.
Thank you
Thanks
so
for
much.
inviting me.
Thanks, guys. Have a great evening
Great
and
to be here.
afternoon.
Good night.
Bye all.
Bye, everybody.